You dangled secret cash back to reel them in?
You cannot prove I hid a single thing.
Once is a mistake, twice is suspicious. Alejandro Curbelo did this across dozens of loans over 2 years at 2 separate condo complexes and left a paper trail for every single one.
It is right here in your own wire records.
Then go ahead and prove
I
it.
already did. That's why I'm standing here.
He would not get to explain. Within 90 days, federal agents from HUD's Office of Inspector General would seize his laptop, his client files, and a stack of HUD 1 settlement statements with his signature on every one. 2 condo buildings, dozens of unqualified borrowers, more than $9.2 million in losses absorbed by American taxpayers. The man in those cuffs was not a mastermind. He was a 32-year-old loan officer in a pressed shirt and a wedding band, and for 2.5 years, he had personally shoveled families into mortgages he knew would collapse. Before we go any further, I have to ask you something. Have you ever sat across a desk from a loan officer, a financial advisor, somebody in a suit, and just trusted that the numbers they were putting in front of you were honest? Drop a comment and let me know. And if you're not subscribed yet, now's the time. This channel covers the people in offices who burned other people's lives down, and we do it every single week. Alejandro Curbelo was born in Hialeah, Florida, in the spring of 1980. His parents had come over from Cuba in the late 60s, part of the second wave, the families that arrived after Camarioca and stayed. His father drove a delivery truck for a wholesale bakery in Medley. His mother worked the customer service window at a credit union on West 49th Street for 19 years. The household did not have money. It had stability, which in Hialeah in the 80s was almost the same thing. Alejandro went by Alex from the time he started kindergarten. Teachers at Palm Springs Elementary remembered him as polite, quick with numbers, the kind of kid who finished his worksheet and then quietly helped the kid next to him. His 3rd grade report card called him attentive and well-mannered, with strong arithmetic foundations. His 5th grade teacher wrote that he works well with others and demonstrates patience beyond his years. Nothing in those early files suggested what was coming. He graduated from Hialeah High in 1998. His yearbook listed him under Future Business Leaders of America and the JV soccer team. He went to Miami-Dade College for 2 years on a partial scholarship, then transferred to Florida International University, where he finished a bachelor's degree in finance in December of 2003. He was 23 years old, the first person in his family to graduate from a 4-year school, and he walked across that stage in a polyester gown, carrying a 4.6 cent GPA and absolutely no debt because his mother had paid every semester in cashier's checks from the credit union. His first real job was as a junior processor at a small mortgage brokerage on Bird Road, a 2-room operation that handled mostly refinances for South Dade homeowners. He made $31,000 a year. He read every file. He learned what a tri-merge credit report looked like, what a verification of employment was supposed to contain, how a debt-to-income ratio was calculated, and what the underwriters at the wholesale lenders were trained to look for. He was good at it. By 2005, he had his Florida mortgage broker license and a new title, loan officer, at a slightly bigger shop on Coral Way. His salary doubled. He bought a used Acura. In the summer of 2005, he proposed to his girlfriend, a dental hygienist named Yari, who worked at a practice in Westchester. The wedding was at a banquet hall on Lejeune Road in November of that year. There are pictures of him on the dance floor with his arm around his mother, both of them laughing, his father in the background lifting a beer to the camera. He was 25 years old, recently married, freshly licensed, and the Miami condo market was about to enter the most insane 2-year stretch in its history. In February of 2006, he was hired by Great Country Mortgage Bankers, an FHA-approved lender with offices on Bird Road and a satellite operation in Doral. The recruiter who hired him said in a later deposition that Alex came across as professional, bilingual, and hungry. His starting base was $48,000. His commission structure was uncapped. On his first day, his manager handed him a list of 2 new condo developments the firm was running financing for. The first was called Dadeland Place. The second was called Pelican Cove on the bay. Both had inventory sitting on the books. Both had developers who were getting impatient. His job was to move units. To understand what Alex Curbelo did, you have to understand what an FHA loan actually is. The Federal Housing Administration does not lend money. It insures loans made by private banks and mortgage companies. The point of that insurance is to let lenders extend mortgages to buyers who would otherwise be shut out. Buyers with smaller down payments, buyers with shorter credit histories, working-class families trying to get into a first home. In exchange for that insurance, the FHA imposes rules. Real rules. The borrower has to actually qualify. The income has to be real. The employment has to be verifiable. The down payment cannot be a secret loan from the seller. And under no circumstances is the borrower allowed to receive undisclosed cash back at the closing table. When everything works the way it is supposed to, the FHA system is a quiet engine of upward mobility. A teacher in Hialeah, a hospital tech in Kendall, a hotel housekeeper in Miami Beach. These are the families FHA was built for. The lender originates the loan. The FHA insures it. The borrower pays a small monthly mortgage insurance premium. And over 30 years, a working family builds equity in a piece of America. When the system fails, when the applications are falsified and the buyers cannot actually afford the homes, the lender still gets paid. The lender always gets paid. Because when the borrower defaults, the FHA steps in, takes title to the property, and writes the bank a check for the outstanding balance. That money does not come from a magic federal account. It comes from the taxpayer. It comes from you. Great Country Mortgage Bankers was an FHA-approved direct endorsement lender, which meant its underwriters had been delegated the authority to approve FHA loans without sending each file to HUD for individual review. That delegation was a privilege. It assumed the lender would police itself. It assumed the loan officers would not lie. It assumed the underwriters would not look away. By the spring of 2006, in two specific condo buildings on the south side of Miami, every single one of those assumptions was wrong. Dadeland Place sat south of Kendall Drive. Pelican Cove on the bay sat off South Dixie Highway in a stretch the developer's brochure called Emerging Waterfront Living. Both buildings had been priced in the boom. Both had been built on the assumption that condo values in Miami would keep climbing the way they had every year since 2002. By February of 2006, that assumption was breaking. Units were not moving. The developers had carrying costs. The carrying costs were eating them alive, and the loan officers who could move units were the most valuable people in the building. The first file came across his desk on March 14, 2006. The buyer was a 38-year-old line cook from a restaurant in Cutler Ridge who made $26,000 a year, had a 580 FICO, an outstanding medical collection from 2003, and $3,400 in his checking account. The unit he wanted at Dadeland Place was listed at $289,000. Even with a 30-year FHA at the rates available that month, the monthly payment with taxes and insurance was going to land around $2,100. The buyer's take-home pay was around $1,500 a month. The numbers did not work. They did not even come close to working. Alex did the math at his desk. He sat with it for an afternoon. Then he opened the file again and changed the income. The verification of employment that went out to the underwriter showed the buyer earning $51,000 a year, with overtime, with year-to-date earnings that matched the new figure. The employer who signed the VOE was a man named Hector, who managed the kitchen and who had been paid $1,200 in cash by a closing assistant working out of the same office. The medical collection vanished from the file because the credit dispute Alex submitted on the borrower's behalf flagged it as not mine. The down payment was gifted from a family member who did not exist on paper, but whose gift letter had a signature and a notary stamp. And the buyer was told at the closing table that $10,000 in cash would be wired to a third party the day after closing, money he would receive in an envelope at a restaurant in Doral that Friday. That was the template. Once it worked again. By the summer of 2006, Alex had a system. He had a network of straw employers willing to sign verifications of employment for a flat fee. He had a notary who would stamp gift letters without ever meeting the person signing them. He had a credit repair contact who would dispute legitimate collections off of borrower files long enough to push the loan through underwriting. He had a closing assistant at the title company who knew exactly how to structure the cashback so it never appeared on the HUD-1. And he had the developer paying closing costs on the borrower's behalf through wire transfers that originated from a bank in another state, an interstate wire that, in the language of the federal statute, would later become count 1 of his indictment. The buyers were not innocent. Many of them knew the deals did not make sense. They had been told, in living rooms in Westchester and in coffee shops on Coral Way, that they could not lose. They had been told the condo would appreciate. They had been told they could refinance in 18 months and pull more cash. They had been told that $10,000, $15,000, sometimes $20,000 in cash back would land in their hands within 48 hours of closing, and that the mortgage payment after that was a problem for next year. Some of them used the money to cover the first 6 months of mortgage payments. Some of them used it to pay off other debt. Some of them used it to throw a party. The escalation was not subtle. In 2006, he closed 11 of these loans. In 2007, he closed 31. By the first half of 2008, he was on pace for 40. He was the top producer in his office for 14 consecutive months. He won a vacation incentive that the brokerage paid for, a 4-night trip to Cancun with Yari, all expenses covered. His base went from $48,000 to $72,000. His commissions in 2007 alone exceeded $140,000. He and Yari moved out of her parents' house in Westchester into a 2-bedroom in a newer building in Doral. He traded the Acura for a leased BMW 3 Series. His mother stopped working at the credit union and stayed home. He paid off his father's truck. No one in his life asked him how he was doing it, not his manager, who saw the production numbers and signed the commission checks. Not his underwriters, who approved file after file, even as the income figures climbed and the credit profiles thinned. Not Yari, who asked once or twice in late 2007 whether he was working too hard and accepted the answer that the market was just incredible right now. Not his parents, who had never in their lives been around someone who made $140,000 a year and who assumed their son was simply being rewarded for being smart, the way they had always been told America rewarded smart people. No one noticed. No one checked. The market broke in the spring of 2008. It did not break gently. The condo values that had supported the entire pretense, the appraisals, the projected refinances, the cash-out story Alex had told every borrower, collapsed inside 90 days. Units at Dadeland Place that had closed at $289,000 in 2007 were appraising at $160,000 by April. Units at Pelican Cove on the Bay were worse. The borrowers who had been promised an 18-month refinance were now sitting on mortgages that exceeded the value of the property by $100,000 or more, with monthly payments they had never been able to afford in the first place, and with whatever cash back they had received long since spent. The defaults started in March. By May, they were a flood. The line cook from Cutler Ridge stopped paying in February. A custodian from Hialeah Gardens stopped paying in March. A hotel housekeeper from Miami Beach, who had been put into a 1-bedroom at Pelican Cove on a $38,000 income that was actually $59,000 on paper, stopped paying in April. By the time the foreclosure filings began hitting the Miami-Dade clerk's office in serious volume that summer, the pattern was already obvious to anyone who looked at it. Same building, same loan officer, same first payment defaults, same FHA insurance picking up the tab. The complaint that turned the investigation from a statistical anomaly into a federal case did not come from a borrower. It came from a HUD analyst in the Atlanta regional office who had been running default rate reports against originating loan officers as part of an internal early warning program. Curbelo's name had been flagging since the previous winter. His 90-day default rate on FHA insured loans was running at more than 5 times the regional average. By July of 2008, more than 40 of his loans had gone into default. By September, every one of them was either in foreclosure or about to be. The analyst routed the file to HUD's Office of Inspector General. HUD OIG routed it to the Miami Mortgage Fraud Strike Force. The strike force was new. It had been stood up in 2007 by the U.S. Attorney's Office for the Southern District of Florida, specifically because South Florida had become the epicenter of the kind of fraud the analyst was now describing. 2 assistant U.S. attorneys, 4 HUD OIG special agents, 2 FBI agents, and forensic analysts pulled in from the IRS. Their entire job was cases exactly like this one. We're about to get into the courtroom. Before we do, leave a comment letting me know where you're watching from, and if you haven't subscribed yet, hit that button. The way this case was put together, the way HUD walked a federal jury through 40 falsified loan files one signature at a time, is the kind of detail mainstream news never bothered to cover. We do that here, every week. The HUD OIG case agents started the way they always start. They pulled the loan files, all of them. By September of 2008, they had requested and obtained, by administrative subpoena, to Great Country mortgage bankers and to the FHA's own archives, every loan Alex Curbelo had originated since February of 2006. The number, when they finished counting, was 41 loans across the 2 condo buildings, with a combined original principal balance of more than $13 million and FHA insurance exposure that would, by the time the foreclosures finished running, generate net losses to HOD of more than $9.2 million. They did not pursue 41 cases. They pursued one case with 41 pieces of evidence. They began with the line cook from Cutler Ridge, the first file. They walked it line by line. They pulled the verification of employment and called the restaurant. The kitchen manager who had signed it admitted within 10 minutes of an agent's visit that he had never employed the borrower at the income listed and had been paid $1,200 in cash to sign the form. He named the closing assistant who paid him. The closing assistant, interviewed 3 days later at the title company office in Coral Gables, named Alex Curbelo. They pulled the bank records. Alex's commission deposits at SunTrust matched the closing dates of the suspect loans to the day. They pulled the developer's records. The wire transfers covering closing costs originated from a bank in Georgia and landed in the title company's escrow account on the morning of each closing. They pulled the cashback records, which were harder because cash is cash. But the closing assistant, by then a cooperator, walked the agents through the mechanics, the side ledger she had kept, the names, the amounts, the dates, the restaurants in Doral and on West Flagler, where envelopes had been handed across tables. The text messages were the part that ended it. Alex had used his work email and his personal BlackBerry for nearly every conversation. The strike force pulled the carrier records and the email archives by court order in November of 2008. What came back was a paper trail no defense attorney was going to put in front of a jury and survive. Closing assistant, May 14, 2007. He's freaking out about the income. Can you push it to 54? Alex, same day. Push to 56. Hector will sign. Send the package today. Closing assistant, June 22, 2007. Borrower says he needs 12, not 10. Alex, same day. Tell him 12, but not at the table. Friday at the usual place. Make sure the HUD shows the seller credit clean. Developer representative, August 9, 2007. How many more do you have for this quarter? Alex, same day. 6 in the pipeline. Need closing cost wires for 4 by next Friday. We'll send a list. There were more than 400 messages in that vein across a 30-month window. The agents printed them out, organized them by loan file, and bound them into binders. By the time the grand jury convened in early 2010, those binders were the spine of the case. They came for him on a Wednesday morning in March of 2011. 2 HUD OIG special agents and 1 FBI agent. They did not come to his office. They came to the condo in Doral at 6:42 a.m. He had just finished pouring his first coffee. He answered the door in a t-shirt and sweatpants. Yari was in the back bedroom. She would not come out for another 15 minutes. Alejandro Curbelo, the lead agent said. Yes. Special Agent Ramos with the Office of Inspector General for HOD. This is Special Agent Vega and Special Agent Doherty with the FBI. We have a warrant for your arrest. Step into the hall, please, and keep your hands where I can see them. He stepped into the hall. He did not argue. He did not run. He had been waiting for the door for almost a year. Sir, do you understand what you're being arrested for? I think so. The charge is conspiracy to commit wire fraud in connection with FHA insured mortgage loans. We have a separate warrant to search the residence. Is there anyone else inside? My wife. Please ask her to come to the front door, slowly. He turned his head toward the bedroom. He did not speak loud. He said her name once, in Spanish, and then he said, Vení, por favor. No pasa nada. Vení tranquila. When Yari came down the hall in a robe, the lead agent showed her the warrant and explained, calmly and slowly, what was about to happen for the next 6 hours. Alex stood with his hands behind his back against the wall, looking at the floor. Mr. Curbelo, the agent said, is there anything in the residence we should know about before we begin? Weapons? Anything like that? No, there's nothing like that. Files? Documents related to your work? He paused. He looked up. In the spare bedroom closet, there's a box. It's all there. Those were the last words he said without a lawyer in the room. The federal grand jury returned the indictment 2 weeks later. The lead count was conspiracy to commit wire fraud in violation of Title 18, United States Code, Section 1349, with the underlying wire fraud counts charged in the alternative under Section 1343. The indictment named Alex Curbelo and 4 co-conspirators, the closing assistant, the kitchen manager straw employer, a notary, and one of the developer's sales representatives. It tracked the scheme month by month, condo by condo, loan by loan. His defense attorney was a former federal prosecutor named Ricardo Almeida, who had handled mortgage fraud cases on both sides of the table. The two of them sat down with the government in the fall of 2011. The numbers were not in dispute. 41 loans, 2 condo buildings, $9.2 million in HUD losses. The only question was what the sentence was going to look like. He pleaded guilty on January 23, 2012, to 1 count of conspiracy to commit wire fraud. The plea agreement laid out the facts in 26 pages. He admitted to falsifying verifications of employment. He admitted to coordinating undisclosed cashback payments to borrowers. He admitted to using interstate wire transfers, originating from a bank in Georgia, to fund closing costs that were never properly disclosed to the lender or to HUD. He admitted that he knew the borrowers were unqualified. He admitted that he knew the loans were likely to default. He admitted that he knew the losses would ultimately fall on HUD. The sentencing hearing was held on June 14, 2012, before United States District Judge Joan Lenard in the Wilkie D. Ferguson Jr. United States Courthouse in downtown Miami. The government called one witness, a HUD OIG special agent who summarized the loss calculation and read into the record 3 short statements from foreclosed homeowners. One of them was the line cook from Cutler Ridge. He said in writing that he had lost his unit, his savings, and his credit, and that he understood now that the deal he had been offered had never been a deal at all. He said he did not blame himself for being told it would work. He blamed the man who told him. Judge Lenard listened. She let the defense speak. She let Alex speak. He stood at the podium in a plain dark suit and said he was sorry. He said he had been 26 years old and trying to provide. He said he had told himself the borrowers wanted the loans, that he was helping people. He said he understood now that he had not been helping anyone. The judge took the binder of plea exhibits in both hands when she began her sentencing remarks. Mr. Curbelo, she said, the conduct described in this plea agreement is not a single mistake. It is a pattern of conduct over 30 months involving 41 separate federally insured loans. Each of those loans represented a family. Each of those families was placed by you into a mortgage you knew they could not pay. The cash-back payments you arranged were not a generosity. They were the bait. The falsified verifications were not a shortcut. They were the lie that made the bait swallowable. And the FHA insurance program, which exists so that working families in this district can become homeowners, has now absorbed more than $9 million in losses because of what you did at a closing table. She sentenced him to 54 months in federal prison, 3 years of supervised release. Restitution to HUD in the amount of $9,200,000, joint and several with his co-conspirators. A debt that, on a former loan officer's earning capacity, he would almost certainly carry for the rest of his life. She designated him to the Federal Correctional Institution in Miami, a low-security facility on the campus of the Miami Federal Correctional Complex, where he would serve the bulk of his sentence in a dormitory housing unit alongside other non-violent federal offenders. Tax cases, healthcare fraud cases, the rest of the white-collar South Florida docket. He reported on August 27, 2012. He served 46 months and was released to a halfway house in Hialeah in the summer of 2016. By the time he came home, his marriage had ended. The Doral condo had been sold. The BMW lease had been surrendered. His mother had gone back to work at the credit union, this time on the morning shift. His father was driving the same delivery truck. The Miami Mortgage Fraud Strike Force charged more than 200 defendants between 2007 and 2012. Alex Curbelo's case is filed under a docket number that, if you looked it up, would not stand out. 41 loans, 2 buildings, 1 loan officer, $9.2 million in taxpayer losses, a line cook from Cutler Ridge who lost his unit, a custodian from Hialeah Gardens who lost her credit, a hotel housekeeper from Miami Beach who is still, 14 years later, renting. This case was bad, but the next one on your screen right now is the kind that explains how an entire country lost its house at the same time. Click it.